Good morning to all. Kolkata Bidhannagar Society for Academic Advancement, West Bengal, India organizes special lecture series program for undergraduate students on finance and its allied areas, coordinated by Azure Academic Services. I would like to introduce our faculty guest, Dr. Madhumita Dasgupta ma'am. She is adjunct faculty at Amity Business School, Kolkata. Good morning, ma'am.
Good morning,
Today's
sir.
Today's topic of discussion is cost of capital, capital structure, and leverage. Over to you, ma'am.
Thank you so much, sir, for the introduction. Good morning, KBSA. Thank you so much, KBSA, for this opportunity.
Good morning, ma'am.
Uh,
Thank you.
and good morning to any and everyone who is viewing this. Today, I will be starting with cost of capital, which happens to be one of the very fundamental and basic concepts of finance, and it also is one of the most critical areas that students usually have trouble understanding. So I will try and make the lecture as lucid and as simple as possible. So here what we have to understand is there is a complete relationship or interrelationship between the different concepts of finance, of which the cost of capital is a very basic scenario which we have to understand. Now, let me just share my screen so that everybody is aware about what is cost of capital. Uh, I hope my screen is visible to everybody. Uh, yes. So,
Yes, ma'am. Visible. Please continue.
oh, is it visible, sir?
Yes, ma'am. Yes. Please continue.
Okay. Yeah. Okay. So, what is exactly cost of capital? We will understand that the definition and the different concepts of cost of capital. So I think my screen is visible, so I'll start away by
Yes,
talking
ma'am.
about cost of
It's
capital.
visible.
Yeah. What is cost of capital? Cost of capital is actually the amount or the return, the rate of return, which decides whether a particular investment is supposed to be made or not. Now, if we try and understand, or if we try and figure out the main concepts of cost of capital, it is the average cost of various capital components which are employed by it. It can also be defined as the average rate of return which is required by investors who provide capital to the company. Now, what does this actually mean? Suppose there is a firm which is firm X, and it has a capital requirement of 1 lakh. Now, if it has a capital requirement of 1 lakh and it is expecting that it will raise finances from the market to the extent of 70,000. So, this 70,000 can come to the company either in the form of equity or in the form of debt. If it is coming in form of equity, it means that these become the owners of the company, the part owners of the company, along with the promoters of the company. Debt is actually the loan of the company. So, in case of debt, when we are talking about debt, then the payment that is made to the loan givers is known as the interest, and that is a legal binding on the company. But if it is an equity share, if the company is getting the funds through an equity share, then the return that the equity holders enjoy is known as dividend. This is not, the company is not legally bound to declare and distribute dividends every year. Dividends, there's a basic fundamental difference between interest and dividend. What is that fundamental difference? And that is based on the fundamental difference between debt and equity. What do you mean by debt? Debt means it is the loan for the company. So when the company is taking a loan, it automatically means that the company needs to repay back the loan. But in case of equity, since equity is a part, or equity is a portion, a proportionate appropriation or proportionate allocation of the company's uh, capital structure, so automatically any shareholder who is contributing towards the equity capital becomes the part owner along with the promoters of the company. He becomes a shareholder of the company. So, in that case, what happens is he enjoys a dividend, and dividends are declared based on the company's financial standing. Dividends are declared based on the company's profit situations every year. So, if there is a particular financial year wherein the company does not have a profit, then it is not legally bound to pay the dividend. Suppose a company has a profit of 10,000 rupees in a particular year. So, if the company is having a profit of 10,000 rupees in a particular year, and the interest amount promised is 10%. So, what was the initial loan figure? The loan figure was 70,000. So, the company needs to pay an interest of 10% of 70,000, which is equal to 7,000. So, this becomes a legal binding. But dividend, as we know, is a return which is enjoyed by the shareholders, and that does not have any legal binding. Neither it has a specific rate of dividend. There is no percentage rate of dividend that can be calculated. How or why a cost of capital is considered? Basically, before we go on to the calculation of cost of capital, let us understand that there are mainly three components of cost of capital. Let me just write it for you so that it becomes easier for you to refer to it as and when you want to. What are the three components of cost of capital? Let me just explain it in detail. The components are, first one is the expected normal rate of return. Second is the premium of the business risk. And the third one is premium for the financial risk. Premium for the financial risk. Now, these are the three components of any cost of capital. What does this exactly mean? This means that when we are talking about cost of capital, then we have to understand that every single firm is taking capital, or every single firm has different sources from which it can gather the capital. So every single source does not have the same liability, neither does it have the same stake. So consequently, it does not have the same costs. So every single security which is involved in the, or rather which becomes the capital component, has a different cost of capital attached to it. Now, how will I show this relationship of the various securities? If we just draw a rough diagram of what are the different securities, and on a x and y scale, then let us just understand this very clearly. Suppose suppose let us understand what is the risk and return scenario of each of the different securities. So on the x-axis, I am plotting the risk. On the y-axis, I am plotting the return. So this part, the line which is horizontal to the x-axis, this represents the risk-free rate. This represents the risk-free rate. So this part, if you notice, is remaining constant as you are choosing the different investment options. So let us consider what are the different investment options. First of all, with the one that starts right at the y-axis is a risk-free securities, which are T-bills, government T-bills, right? Then we have the next one is government bonds. The next in that line, we have corporate bonds. The next we can talk about is pref shares, and the last in the list is we have equity shares. So if you look at this diagram, you will clearly understand that the part which is below the horizontal axis, horizontal line, like that is the one that I have just bracketed, is the part which is the risk-free rate, and your total risk is actually this entire portion. This portion is your total return which you enjoy from a security. So if we are, suppose we are talking about pref shares, so in case of pref shares, this part is the risk premium, and this part, the part which is below the horizontal line, is your risk-free rate. So any security has got has got two components, that is return has got two components in every situation. One is the risk-free rate, plus the risk premium. So if you look at the diagram, you will clearly understand that if we are talking about the risk premium, then the risk premium plus the risk-free rate comprises of the return. And as we are moving away from the axis towards equity shares, the risk-free rate remains the same, whereas the risk premium keeps on changing. Now, why does it keep on changing? Understand that. In case of government bonds are backed by government security. So the amount of risk premium that you have in case of government bond is going to be lesser than the amount of risk premium that is enjoyed by corporate bonds. Why? Because suppose an investor is thinking about and looking at, suppose I am as an investor or a novice, I look at the diagram, and what do I find out? I find out that the government bond is giving me a return of suppose 7.5%, and the corporate bond is giving me a return of suppose 9.75% or 9.5% for that matter. Let me just write this for you so that you will understand. Suppose government bond is having a return of 7.5%, and corporate bond is having a return of 9.5%. So there is a clearly 2% difference between the two investment options. Now, in both these two category of investments, we have to understand that there is a return, or there is a risk-free return, which is a common component in both the return scenarios. The risk-free return, suppose the risk-free return is 5%. So in case of government bond, we have risk-free return of 5% plus the risk premium of 2.5%, which makes it 7.5. In case of corporate bond, in case of corporate bond, we have the return of 5% again, which is the risk-free rate, plus 4.5%, which is the risk premium. Now, why there is a difference? Of course, we can clearly understand that in case of government bond, it is backed by the government security. In case of corporate bond, since it's a private organization, there is a higher amount of risk which is involved. Automatically, the investors should get compensated for the extra risk that they are taking while making an investment in the corporate bond. Similarly, if we go back to the diagram, if we look at the diagram again, then we can find pref shares. So the 5% common component of risk-free rate is common there as well. But the amount of risk premium is much higher as compared to the government bonds or the corporate bonds. So automatically the pref share total return becomes higher. And the highest in the entire diagram is equity shares, which has the highest amount of return percentages in each sense of the word. But do not be deceived by the fact that it is having the highest return means the risk-free rate is changing. No, the risk-free rate is absolutely not changing. The risk-free rate is completely staying same, which is 5%. The what is changing is the risk premium, because the risk premium is actually resulting in the increase of the total return which is being offered by the equity shares. So we clearly understand the relationship between the risk and return when it comes to different investment options that the investors have. So a single investor, if he has a lesser amount of risk tolerance, then the person will not make an investment in equity or a preference. The person will definitely go for a government bond or a corporate bond. That depends on completely on the risk tolerance of the investor. So up till here, I think the situation is that we have understood how the risk return relationship is working. So and what is exactly the concept of cost of capital. Now this return, understand this now, where do we how does the cost of capital come into the scenario? The return that the company is promising to the investors is actually becoming the cost for the company. How come? Suppose the company, the example that I had taken, that there is a loan of 1 lakh rupees which the company has taken from the investors, and the investors are expecting a 7% return. So if the company is expect 10% return, and the loan was for 70,000, so the interest amount paid was 7,000. So this 7,000 or the 10% is actually the cost of debt that the company has to bear in order to gather funds of 70,000 from the market, so that it is able to carry out its operations without any hindrance. So this 10% becomes the cost of capital for the debt when it comes, or when we look at the cost of capital scenario from the perspective of the company. uh, Now let us next discuss that what the next thing that we would understand is why is the cost of capital cost of capital important? What is the significance of cost of capital? First is, the first and the foremost job of the calculation of cost of capital is evaluation of investment projects. When we talking about evaluation of investment projects, it means that we have different projects which are happening for the particular company. Suppose a company has a investment project of uh, suppose X is a firm and it has an investment project which is costing 5 lakh rupees, and it's promising a return of suppose 10%. For this 5 lakh rupees, the firm needs to raise the finances from the market. Now, if it is raising the finances from the market, what are the possible ways in which it can raise the finances? Either it can do it from debt or it can do it from equity. In both the cases, if it is raising the finances from the market through debt or equity, both of them are asking for a return. In case of debt, it is the interest, and in case of equity, it is the dividend. Now, we have to understand that the return percentage of 10% is the maximum amount of return that the company is getting from that project. So, in order to finance that particular investment, the company needs funds, and the cost of financing this investment should not be more than 10%. So ideally 10% is the maximum return, and therefore cost of capital should always be less than 10% for this project. Because if it is more than 10%, the company will actually not be able to pay the investors the amount needed, because it's not getting a return of more than 10%. If it is not getting a return of more than 10%, how will it manage to give a return of more than 10% to the investors? So it is always feasible to have a return which is going to be less than 10%. So this is how the relationship works. Now, next is what is the next significance of cost of capital? Designing a firm's debt policy is the second one. What does it mean? It means that the company has to understand that what if a certain amount of money is the total requirement of company, and the two ways in which the company can raise finances is either through debt or through equity, then it needs to understand what proportion of the required capital can it raise from the debt finances or from the equity finances, because that will definitely depend on the cost, or that will definitely determine how much the company is able to allocate its funds properly. Next that we will discuss is what are the different concepts, or what are the different categories of cost that we need to understand in order to move further ahead and know how capital or how costs are calculated. So when we are talking about classification of costs, there are mainly the following categories. If we classify cost, we have to understand what are the different classification of costs. Point one, the first one is historical cost or future cost. The second is specific cost, specific or composite cost. Third is explicit. Explicit cost or implicit cost. And the fourth is average cost or marginal cost. Now, what is the first one? Historical cost and future cost. Historical costs are the book costs which are related to the past, and future costs similarly are estimated for costs of the future. In case of financial decisions, future costs are more relevant than the historical ones. The second one is specific or composite cost. What is specific cost? Specific cost refers to the cost of specific source of capital which is employed. On the other hand, composite cost is the combined cost of various sources of capital. It can also be expressed as weighted average cost of capital, which is another very important area of calculation which we will be doing. So that is the meaning of a specific cost and composite cost. The next is implicit and explicit. What is implicit? It is simply the discount rate which equates the present value of cash inflows with the present value of cash outflows. If we are aware about the concept of NPV, then implicit cost is simply the I that with which we are discounting the cash inflows and equating it with cash outflows. That's all that implicit cost means. Explicit cost means. And implicit cost is also known as the opportunity cost, which is the cost of opportunity foregone in order to take up a particular project. The last one is average cost and marginal cost. What is average cost? Simple. Average cost refers to the combined cost of various sources of capital such as debentures, preference shares, and equity shares. And it can also be expressed as the weighted average cost of capital. So if we look at the other concept, uh, specific cost and average cost more or less are the same thing. So specific cost in the third option and the average cost in the fourth option have the same explanation. Marginal cost, on the other hand, refers to the average cost of capital which can be incurred to obtain additional funds required by the firm. So if I have already issued equity shares and the company is already financed its requirements with the different equity shares, then if the company finds out that there is an extra requirement of an extra equity share or extra finance is required, for which it is again raising some funds, then that particular concept is known as the marginal cost. So these are the different categories of costs that we have usually. And now let us delve into the main area of how the different costs are computed. That is, how the different calculations are done for the different components of the cost. So there are mainly three components or three types of capital that will be considered for calculation of cost of capital. So let us understand what is the different computation. Computation of cost of capital. The first component is cost of debt. Second component is cost of equity. Cost of preference. And the last one is weighted average cost of capital. Now, what is cost of debt? Let us understand what is cost of debt first. It is the rate of interest payable on debt. It is the rate of interest payable on debt. Now, what is exactly rate of interest payable on debt? The example that I had given some time back when I just started the class, that suppose a company needs 70,000. Suppose a company needs, for example, suppose a company needs 1 lakh, and the company is promising a return of 7%. So, how much is the company going to give? 7,000. So, that this 7% is actually the cost of debt, because that becomes the cost at which the debt is available to the company. So this becomes the cost of debt. Now, how is this cost of debt calculated? There is a particular way in which it is calculated. The formula we have is KD is equal to, D will be in suffix, KD is equal to interest divided by B0. 0 again will be in suffix, where KD is cost of debt, interest is the coupon rate, and B0 is the issue price of the debt. So, in this particular case, what usually happens is, if I'm talking about interest is this part that I had just explained to you in the class. That the 7,000, this particular part is actually the interest part, which the company has to pay to the different bond holders. In this case, if I'm talking about debt, I'm talking about bonds only, or debentures. But in explanation part, we usually use the term bond. So that is why you will also find that you are using B0 here. That is bond. B is signifying the bond actually. Now, in case of interest, what usually happens is, since 1 lakh, since 7,000 is the interest payable, so interest in the numerator, I'm writing 7,000. What is my B0? B0 is the price that I am paying for the bond. Now, you might get confused as to what is the difference. What is the difference between the face value and the price that the bond is charging? The face value or the nominal value or the par value is the value that the individual or the investor is going to get once the bond has reached its maturity. So when the bond is, suppose the bond is for 5 years. So if the bond is for 5 years, suppose if I take an example that a bond of 5 years or a debenture of 5 years has a face value 5 years has a face value of rupees 1000. So this is the face value of the bond, and and it is sold at rupees 89.25. So this is actually the B0 or the price of the bond. Now, how does B0 or the price of the bond is determined? Simple. B0 or price of the bond is the present valuation of all the future benefits that the bond promises the investor. Suppose this particular example, there is a 5-year bond. So if the bond is for 5 years and the interest is suppose 7%, the same sum that we are discussing, 7% is the interest, and the total amount is 1 lakh that the investor has invested. So which means what? For next year 1 to year 5, the amount of interest or coupon payment will be how much? It will be 7,000. 7% of 1 lakh. So every year, the bond is going to pay an interest of 7%, which is 7,000 in amount. Which means what? That the bond is paying this 7,000 every single year. Now, when I'm saying it is paying every single year, it means I'm not receiving the money as on date. So automatically, I don't know, and we all know that the concept of NPV tells us clearly that the value or the amount or the valuation of money received today is definitely not same as the money received on some later date or some previous date. So if I'm receiving 7,000 today, I know the valuation is 7,000. Fine enough. But if I'm receiving 7,000 1 year later, 2 year later, 3 year later, and like this for 5 years every year, cumulatively, I don't know the valuation of that 7,000. So what do I have to do? I will have to bring all of those 7,000 rupees to today's valuation by discounting. And once I'm discounting that, then the next thing that I'll do is the 1 lakh, the face value is also 1,000 rupees. The face value is which is given in the sum of 1,000. So the total investment that the person has made is 1 lakh to the extent of 1 lakh. So I will have to bring down the redemption amount of 1 lakh again on the investment to its present value, because I'm not receiving that one redemption amount today. I'm receiving that redemption amount after 5 years. So that redemption amount also has to be brought to the present value. Add all of them up, and whatever is my added or summation of that total present values, that is the total income, or that is the total value that I receive from the bond. Now if I find that the bond is selling at a lesser price than that cumulative figure that I have arrived at, then we call it that the bond is underpriced. Otherwise, we call the bond is overpriced. I'll come to the bond value calculation part. So, if we simply understand that this is how bond valuation is done. So, if I am looking at the example that I have given you, and if I just work out that example, then ideally my B0 should be equal to interest by 1 plus kd to the power 1 plus interest by 1 plus kd to the power 2 plus interest by 1 plus kd to the power 3. So every time you see that I am giving a power based on the number of years. So I will be doing this for next 5 years. So interest by 1 plus kd to the power 4 plus interest by 1 plus kd to the power 5, which means for all the interest amounts of 7,000 that I am receiving, I am discounting them, bringing them down to today's value, plus the redemption value divided by 1 plus kd to the power 5. So this is how I arrive at B0. So when I'm trying and figuring out what is my KD is interest divided by B0 in case of a bond which is simply a perpetual bond. And if it is time bound, which means it's redeemable, then this is how I will calculate my B0. In order to find out my KD, I have a simple equation which will help me to find out KD. Why do I need a equation like this? Because KD already has a power attached to it. So the formula is going to be a bit different. What is my KD? I will calculate my KD as interest plus 1 by n f minus b0 whole divided by interest uh, okay, not interest, it's half divided by f plus b0. Now simply let us take an example for this particular formula that I have just found out. Suppose for example X is the firm issues bond at a discount of rupees 94 and the duration is 7 years. Rate of interest or coupon rate is 15%. Let's just take this example. So I can clearly understand that the face value of the bond which is given to us is 100 since it's being sold at a discount of 94. So we can understand that the face value is 100. The B0 is 94. The duration of the bond, that is N, is 7 years and coupon is 15%. If I simply apply this formula and I try and find out the KD, I'll be clearly able to find out the KD. So what will be my KD? It's 15 rupees. How did I find out 15 rupees? Simple concept. 15% of 100 is actually 15. So 15 plus 1 by 7 is the number of years. My face value is 100. So F is 100 minus B0, which is 94, which is already given. The entire thing divided by half into 100 plus 94. If you make the calculation, then it is coming to 15.86 divided by 97. The answer comes where? Is somewhere else, 16.4. So my KD happens to be 16.4. So this is the formula for cost of debt. Now next is cost of equity. Rather, let me just move on to cost of pref shares, and then we'll move on to cost of equity. Cost of preference shares. Now, in case of cost of preference shares, if it is irredeemable preference share, that is, it is going on for eternity, if it is irredeemable preference shares, if it is going on for eternity, my cost of preference share is KP is equal to PDIV. What is P? I'll explain what is PDIV. Divided by P0, where KP is cost of preference shares, PDIV is preference dividend, P0 is the issue price of the pref shares. Okay, now next concept that we will be discussing is in case of redeemable preference shares, the situation is somewhat similar to the concept of bonds. In case of redeemable, if it is irredeemable preference shares, I just give out the formula. If it is redeemable preference shares, the formula is somewhat similar to my bond scenario. Here, instead of P0, I'll write B0 similarly. So, so here, in both the situations, that is cost of debt and cost of preference shares, what has happened is this is not tax adjusted, but of course when we do the calculations we will have a situation where it will be tax adjusted cost of capital. for both the situations that we will be discussing. It will be tax adjusted cost of capital. The next is cost of equity capital. This happens to be one of the most complicated and one of the most critical calculations that needs to be done, because in case of mind it's everyone, in case of equity capital, it is difficult to ascertain the total percentage or the rate at which dividend is paid, because there is no fixed rate. And every year the rate keeps on changing. In fact, every year the amount of payment keeps on changing, because dividends are all paid in amount of money. So they are not calculated as a percentage of the interest, percentage of the investment. They are calculated based on the distribution rates that the company decides, which is again based on the profit percentages of the company. So automatically, what happens is, in case of equity, the calculations are a bit different. Mm, There are certain things that we need to discuss in order to understand cost of equity capital. There are two categories of equity. One is internal equity, another one is external equity. Internal equity means the retained earnings. And second is external equity is new issue of new issue of equity. So these are the basically two categories of equity that we have. One is the retained earnings. The second one is the new issue of equity, which is done by the companies. So can it be said that since equity is not compulsorily paid and there is no legal binding to pay a dividend, can we say that equity shares are free of cost? Of course not. Equity shares are not free of cost. They are basically involved in more of an opportunity cost, because ordinary shareholders supply funds to the firm in the expectation of dividends and capital gains, which is going to suffice or which is going to cover up their risk of investment. Therefore, and automatically, another thing that we have to keep in mind is the market value of the shares determined, which is of course determined by the market demand and supply mechanism, actually reflects the return required by ordinary shareholders. So, the shareholders' required rate of return with the market value, which equates the present value of the expected dividends with the market value of the share, is the cost of equity. I'll repeat this particular line again, and I'll write this so that it becomes a better reference. The shareholders' required rate of return the shareholders' required rate of return, which which equates the present value of the expected dividends which equates the present value of the expected dividends with the market value of the share is the cost of equity. Now, in case of, let us understand how cost of equity is calculated. There are basically three situations when we are going to calculate cost of equity. There are basically three situations where we are going to calculate cost of equity. What is the first situation? The first situation is normal growth. Situation number one, it is normal growth.
কথাই নিয়ে মনমূল লেখা শুরু করে পারে।
What is normal growth? Here, dividends are expected to grow expected to grow at a normal rate. Dividends are expected to grow at a normal rate. The formula is P0 div ke minus g, where div1 is equal to div0 1 plus g. So, if we just simply reverse the equation, then we will get ke is equal to div1 by p0 plus g. Now, there are certain assumptions that we follow in this particular situation. What are those assumptions? The P0 or the market price of the ordinary share is a function of expected dividends. Second point, DIV1 0 is greater than 0. Sorry, DIV1 is greater than 0. The third assumption is dividends grow at constant rate. And dividend payout ratio is also constant. The next is supernormal growth. The second situation or the second scenario is supernormal growth. In case of supernormal growth, the formula that we have is P0 is equal to summation of T is equal to 1 to n div0 1 plus gs to the power t whole divided by 1 plus ke to the power t plus pn divided by 1 plus ke to the power n. This particular equation where we have ke, in order to find out my ke, the method that we use in case of IRR, that is NPV IRR, internal rate of return, similarly that same method we can apply for trial and error method and complete the calculation and find out my cost of equity capital. The next situation that we have is known as zero growth. The third situation is when dividends grow, there is no growth in dividends, so there is zero growth. Here, it's a very simple scenario. Ke is equal to div1 by p0. So this is the basic concept of cost of equity, cost of debt, and cost of preference shares. The next thing that we will be discussing is WACC, that is weighted average cost of capital. Weighted average cost of capital is the total component costs multiplied by the weights, and therefore we find out the weighted average cost of capital. So every single cost of capital based on the proportion of capital utilized in the total capital structure is going to be the WACC. So if I want to show it as K0 or overall capital KO, then KD 1 minus T, that is tax adjusted, D by D plus E. Why am I doing D by D plus E? Simple, because D plus E signifies my total capital structure in the organization, and my KE in KE E by D plus E. So this particular part is actually the weight part. This particular part is actually the weight part. So if I want to put it like this, the another formula is or KO is equal to K1W1 plus K2W2 plus KNWN. So whatever are the number of components which are used in the capital structure, all of them based on their weights multiplied by the respective costs of capital will give me the total weighted average cost of capital. So if I simply put that, if I have already found out that my KD is 6% and KE is 5%, and I know my total debt in the capital structure is 70, and the total equity in the capital structure is 130. So my total capital structure is 2 lakhs. So I can clearly and simply find out. I'm going to say 6% multiplied by 70 divided by 2 lakh plus 5% multiplied by 1 lakh 30 divided by 2 lakh. So my answer comes to be this is, if 6% I convert it in decimal, it's 0.06 multiplied by 0.35 plus 0.05 multiplied by 0.65. Zero point 0.021 plus 0.0175. Zero point 0.038. So if we simply multiply it with 100, it's 3.8%. So my KO or overall cost of capital is 3%. So this is how we calculate working weighted average cost of capital. Now, what is the next thing that I'll discuss today is actually known as the capital structure. Now, what is capital structure? Capital structure, clearly, the concept of capital structure clearly says that for every single organization, there is a, as we have just discussed, that there is a different amount of components that we usually have, or different capital components or sources of capital that we usually use. And the capital structure theories can be defined according to, so the next heading that we, or the next area that I'll discuss today is capital structure. So capital structure has got, it refers to the composition or makeup of its capitalization, and includes all long-term capital resources like loans, reserves, shares, and bonds. It is made up of debt and equity securities and refers to permanent finance of a firm. Now, there are certain theories of capital structure. We will just discuss them. Theories of capital structure. First one is net income approach. Second is net operating income approach. And the third one is traditional approach. And the fourth one is Modigliani-Miller approach. Now, what is the net income approach? This theory says, the first one, NI approach as we call it, says that a firm can minimize the weighted average cost of capital the firm can minimize the weighted average cost of capital and increase the value of the firm by increasing the debt of the firm. Now, this approach has certain assumptions, and that is, there are no taxes involved. Of course, the cost of debt is less than the cost of equity, and the risk perception of investor does not change if debt is used. So these are the basic three assumptions that are given. First is the risk perception of the investors does not change if debt is used. Secondly, is there are no taxes involved. And thirdly, that the cost of debt is of course lesser than the cost of equity. Next, we have the net operating income approach. It is another extreme as compared to NI approach. According to NOI approach, according to NOI approach, Change in the capital structure does not bring about any change in the value of the firm. And also the WACC remains constant. So the two concepts are completely at opposite ends of the pole. One says that as you change the debt, the value of the firm increases, and also the weighted average cost of capital changes. Whereas NOI approach says that even though you change anything in the capital structure, whether you decrease or increase debt, that has got no bearing on the total value of the firm. The value of the firm does not change. Also, the WACC remains to be constant. Next is traditional approach. The next concept that we will be discussing is traditional approach. Where sir, is my screen visible? Because I'm not able to see whether my screen is visible or not. It is showing blank. So could you just confirm whether the screen is visible? I hope it is visible. The screen is visible because I'm explaining it on the screen itself. The next is traditional approach. This approach is somewhere between the two extremes of NI and NOI approach. This approach says that initially when debt is increased, the value of the firm increases, and it reaches the optimum debt equity mix. But once it reaches that particular point, beyond that point, beyond that point, the value of the firm does not increase if debt component increases. if debt component increases. The last one that we are discussing in case of capital structure is the Modigliani-Miller, the approach. So what does the Modigliani-Miller approach says? This concept says that the value of the firm has no relation to the debt equity mix. The value of the firm has no relation to the debt equity mix. And why does this concept, why does it say this? It is saying because, suppose, according to this theory, if debt increases, suppose debt increases, if debt is increasing, then it is resulting, again I'll repeat, if debt is increasing, then it is also resulting in an increase in the cost of equity. Why? Because in order to finance the debt, or in order to circum the debt, the equity is also having an increase. So automatically this transpires that in case of debt, if debt is increasing, then it is also resulting in a cost of increase in the cost of equity, which ultimately offsets the concept which is propagated by NI approach or NOI approach for that matter, that there is some relation with debt and the value of the firm. So either way, if the debt is increasing, automatically the cost of equity is also increasing, then actually it is having no relationship. So Modigliani-Miller approach says that in absence of taxes, if debt increases, then there is no relationship between, or there is no bearing of debt with the value of the firm. That is what Modigliani-Miller approach usually says. Now, what are the assumptions in case of Modigliani-Miller approach? There are certain assumptions that we have to be considering. First is, the first assumption is there is no corporate taxes. I'll repeat it again. In case of Modigliani-Miller approach, it is said that there is no corporate taxes which are involved. Second assumption is it is a perfect market. There is a perfect market. And the third assumption is investors are acting rationally. The fourth assumption is the cutoff point of investment in a firm is the capitalization rate. And the last assumption is all earnings are distributed to the shareholders. So we clearly understand that whatever is the debt structure of the firm, that is completely reflected and that is completely visible. Also, since the entire earnings are distributed among the equity shareholders, so automatically there is no retained earnings, no reserves for the company. So if the company is not having any reserves, there are no funds which are internally getting created. Automatically every single reserve creation is pretty visible, and therefore there is a direct relationship between the cost of debt and the cost of equity. The increase in debt is actually resulting in an increase in equity. So that is where approach says that we do not have any bearing on the value of the firm based on the which is going to be affected by the debt equity mix. The next topic that I'll be covering and trying to explain to you people is known as leverage. Now, what is leverage? If we are understanding, since we are doing cost of capital, since we are doing capital structure, all of them are more or less related with the capital structuring of the company. So, leverage automatically transpires to be the very much related topic with respect to cost of capital and capital structure. So, let me just first tell you what is the meaning or what is the concept of leverage. Leverage simply means that the amount of debt which is used in an organization. I'll repeat it again. Leverage simply means the amount of debt which is used in a organization. So when I am talking about leverage, leverage deals with the costs involved, or leverage deals with the scenarios or components involved when we are talking about the debt capital of the organization. So if debt is more, then it is considered as a highly levered firm. If debt is not there, then it is known as a non-levered firm. I'll repeat it again. If debt is there, it is known as a highly levered firm. I'm so sorry. Just give me a moment. Okay, excuse me. So, if debt is there, then it is considered as a highly levered firm. If debt is not there, then it is considered as an unlevered firm. Now, how do we explain the concepts of leverage? How do we explain the concepts of leverage? Let me just first tell you how the concepts of leverage can be explained. I hope my screen is still visible. So I'll start with the leverage part. Leverage. So leverage means the amount of debt used in the capital structure of a firm. So when I'm talking about leverage, it can be stated as the use of fixed charges, sources of funds like debts, and preference capital along with owner's equity in the capital structure is described as the is described as the financial leverage or gearing or trading on equity. Now, this term trading on equity is derived from the concept that the owner's equity is used as a basis to raise the debt. Now, what are the different measures of financial leverage? First one is debt ratio. What is debt ratio? Debt ratio is the total amount of debt divided by debt plus equity or debt by value of the firm. That is my debt ratio. Second is the debt equity ratio. Which is simply put as D by E, debt by equity. The third measure of financial leverage is, or rather leverage, is interest coverage ratio. Which means coverage is equal to EBIT by interest. Now, basically, there are two categories or types of leverage. One is, if we talk about the different types of leverage, Then we have two types of leverage. One is, if I write the types, first one is operating leverage, and the second one is financial leverage. How do I explain operating leverage? Operating leverage is known as degree of operating leverage, rather. Its formula is DOL is equal to percentage change in EBIT whole divided by percentage change in sales. Another formula that can be used for operating leverage is contribution divided by EBIT. Now, you might have a question as to how will I arrive at EBIT or contribution? How do I get it? Simply put, if I show it in a different parameter, suppose there is the first parameters are the sales which are happening in an organization. That is the first revenue earning mechanism. From that, the first thing that gets deducted is the variable cost, that is VC. What we arrive at is known as contribution. This chart, I think it's one of the most fundamental charts in finance, and I think this chart is going to stay with any finance practitioner or any finance individual as long as the person understands and wants to know about finance. So sales minus variable cost is contribution. Contribution minus fixed cost is profit. Another name for profit is also known as EBIT, earnings before interest and tax. Right? Next, from this, if I am deducting minus interest, this interest is actually the interest that the dividend, that is the debt holders are getting at the end of the financial year. What remains as EBT, from that taxes are getting reduced, that is the corporate taxes, and then we have EAT or PAT. So this is the entire flow chart. So when I'm talking about the EBIT, then this EBIT means the contribution. When I'm talking about degree of operating leverage, I'm talking about contribution, this part here, that is this one, and EBIT. These two I'm going to find a ratio of. That is how I find out my EBIT. Now, if I'm going to replace contribution, then contribution can be replaced as EBIT plus fixed cost divided by EBIT. I hope this much is clear. Because a contribution is simply contribution minus fixed cost is EBIT. So if I'm replacing contribution, I can simply say that EBIT plus fixed cost is contribution divided by contribution and divided by EBIT. So it's actually 1 plus fixed cost by EBIT. I simply cancel out EBIT in the numerator and the denominator. The next one is the next one that is the next calculation that we'll do is degree of financial leverage. Now, what is degree of financial leverage? This also has a formula. Percentage change of EPS divided by percentage change of EBIT. Now, how do I find out EPS? In order to calculate EPS, simply EPS is equal to EAT by number of shares. So since I already have the flow chart with me, I have already found out earnings after tax. I simply divide EAT or PAT by the total number of shares. I'll get my EPS. EBIT, simply EBIT is already found out. So percentage change in EPS divided by percentage change in EBIT. That is my formula. And another formula of DFL is interest, or that is the interest component, EBIT divided by EBIT minus interest. So I can also write this as EBIT minus interest is EBT or PBT. Minus EBIT minus interest. So if I put it the other way, it is also can be written as 1 plus interest by PBT. So these are the formulas of degree of operating leverage and degree of financial leverage. Next that we will discuss is degree of combined leverage. Degree of combined leverage. Now, how do we calculate degree of combined leverage? In case of the percentage change formula, degree of combined leverage is dual multiplied by DFL. So if we put the entire formula of degree of combined operating leverage and degree of combined leverage, financial leverage, then the formula stays as percentage change in EBIT divided by percentage change in sales multiplied by percentage change in EPS divided by percentage change in EBIT. So you can cancel out EBIT, EBIT. What remains is percentage change in EPS whole divided by percentage change in sales. If it is a percentage, so here also the degree of combined leverage, if we find out the other formula, degree of combined leverage is 1 plus interest plus fixed cost whole divided by PBT. This is the second formula from which we have derived this combined formula. So suppose, for example, if an organization has a DFL of or a DFL of 3.5 and a DCL, DOL of 2.5, then the DCL will be 3.5% into 2.5%. So this is going to be a simple formula. Now, here comes the situation as to there is another concept, the last concept that I'll be discussing before wrapping up the session is the interest tax sheet, one of the most important concepts that we have to understand. The interest tax shield, the reason, one of the basic reasons why we do the leverage. I had beforehand I had explained the flowchart: sales minus variable cost, we get contribution. From the contribution, I'm deducting the fixed cost. What I'm getting is EBIT or PBIT. From that, I'm deducting interest. What I'm getting is EBT or PBT. From that, I'm deducting the tax. Finally, I'm getting EAT or PAT. Now, understand the scenario. If my debt or if my loaned capital is increasing, then automatically this interest component, this particular component, this interest part is increasing. If it is increasing, then automatically this will come down. If this is coming down, then consequently my tax is also coming down. So the more I am paying interest, the more the firm is paying interest, the lesser is the tax liability for the organization. So this is known as interest tax shield. Organizations usually invest in debt in order to escape the extra or the incremental taxes that they have to pay to the firms, to the government. So they are making an investment in they are taking investments in form of loans from the investors so that they pay higher interests. Based on the higher interests, their EBT or PBT goes down. Consequently, their tax liabilities also come down. So this is how taxes are reduced by organizations through debt financing. One of the major concepts of debt financing is this. So here I would like to specify some important points, that cost of capital becomes one of the most fundamental areas of finance. It is one of the most basic and the most significant concepts which will define how the companies or how the firms are designing on their capital structure. So they will actually make sure that the companies are able to perform in a better way if they have a very optimum security mix of both equity and debt. And also capital structure, cost of capital, leverage, all of them are interrelated. We tend to understand these concepts in tandem with each other. In order to understand them, we need to understand what are the different sources of finance first. We need to understand how the different sources of finance are reacting to each other. Why is a debt mainly considered a debt, and why is how does the equity of a firm back up a debt? All these concepts are very important. So whenever cost of capital is to be studied, it can't be studied in isolation. There has to be a constant interaction with cost of capital. What is the return, how the cost of capital is calculated, how leverage is related, and how debt is related. So all these concepts coming together and they have a synergistic relationship with each other as well. So this is how cost of capital, leverage, capital structure can be evaluated. It can be understood. I hope I have been able to give a more or less comprehensive concept and idea. There are of course things, there are a lot of things that we need to discuss in further if we want to understand and do a research on this subject further. But these are the basic areas that a student needs to understand in order to get the hang of how the chapter or how this particular topic is going to be handled. There are certain areas or assumptions whenever a particular topic is to be done. If there is a particular theory, if there is a particular concept, the assumptions are very important. So the assumptions have to be kept in mind always in order to understand the concept. So these are the various areas that I have discussed today. I would like to wrap up the session now and give the mic to sir. Sir, could you just take up? I think I have completed my session. Thank you so much.
Thank you so much, ma'am, for your lucid explanation on cost of capital, capital structure, and leverage. It was really engaging and insightful session. I clearly believe undergraduate
Sir, I
students.
can't. Sir, can you be a bit louder? I can't hear you. Are you saying something to me?
Yes, ma'am, you can. Okay.
I can.
So,
Can I leave the meeting then?
yes, ma'am, you can.
Thank you so much, sir. Thanks a lot, and I thank ABSA for
Follow.
this opportunity. Thank you so much.
Okay, ma'am. We are concluding this session. Thank you,
Thank
ma'am.
you so much. Thank you, sir.